Housing market crash has just begun.
And here we've got US National Home Price Index. In 4 months, home price growth collapsed from a 3-month growth rate of plus 25% to minus 4%. And remember, this is August data before the surge to 7% mortgage rates. And as Misa said, the bigger the boom, the bigger the bust. And here we've got US housing starts during policy rate tightening cycles between 1972 and 2022. You can see that 2022 is falling faster than ever before and is pretty much matching 1980. And Adam Taggart shares this Yahoo Finance article, buckle in for a brutal free fall in home prices, and US housing is in a massive bubble, experts say. Adam says the mainstream media cheered on this latest housing bubble and convinced buyers to purchase at stupid valuations. Only now do they admit the obvious years too late. And I'd also say that even many of these experts also were cheering on the housing bubble. And while people like myself were warning about it, even when housing was going up like a meme stock, well, here we are. But don't worry, guys, because Dave Ramsey says that home prices are not going to go down. That's right. Back in June, he said home prices are not going to go down. Now, I like Dave Ramsey, but you know he should stick to what he does best, and that is teaching people, helping them get out of the you know what, teaching them how to manage their income, that financial management side of things. He's good at. Stick to that. The guy doesn't understand macro. He doesn't understand economics at all. And he shouldn't be getting into the game of predicting what asset classes are going to go up and go down, and etc. Because the guy doesn't have a very good track record with that. Remember what he had to say back in 2007, 2008? Also said the same thing. Home prices aren't going to go down. Oh, what are you talking about? Dave, I like you, mate. Stick to what you do best. Stick to your steps, how you teach people to manage, their income and allocate their income and all that sort of stuff. I absolutely agree with that. Sound advice there, mate. Don't go saying this asset class is going to go up or this asset class is going to go down, etc., etc. You don't know what you're talking about, buddy. And Keith Weiner gets it here when he says an underappreciated idea of the Austrian school. The damage is done during the boom. The bust does not destroy wealth. It's just the accounting catching up to the reality. And that's, Austrian economists. That's why Austrian economics have predicted every boom and bust for the last 100 plus years. And back in September, the world's hottest housing markets are facing a painful reset. Now, about 55% of its outstanding value of residential mortgages is either on a floating rate or on a fixed rate that needs to be renewed in the year of to July 2023. A lot of people aren't talking about New Zealand, but they have been the canary in the coal mine because their Reserve Bank started raising rates before really any other Western Central Bank did, and their house prices began falling before other jurisdictions. And so I've had my eye on New Zealand for some time. Now, Australia, very similar. In 2020, there were a lot of people that took out 2 and 3 year fixed rates at 1.89, 1.99%. Well, they all roll over as well around from July onwards in 2023. So we're going to see a lot of Australians also reverting back to much, much higher rates. But even with that, Australia, variable rates as a percentage of 2020 new loans, Australia's always had about 85% of mortgages, or 85% of mortgages that are variable or floating, as our Kiwi brothers and sisters call it. However, those fixed rates at 1.89, they're going to roll over to what, 6.5%, 7%? That's going to hurt. And so you can see from this chart that New Zealand, Auckland, their property began to fall. Their property prices began to fall first, but now we're seeing everyone, Sydney, Stockholm, and now even Toronto. And speaking of Toronto, let's have a look at Canada. And house price to income ratio, Canada, followed by Australia. House price to rent ratio, Canada, followed by Australia. And real house prices, Canada, followed by Australia. And Adam Taggart once again sharing this New York Post article. Home asking prices tumble at record pace as mortgage rates surge. As I've been saying for months, it's just math. Raise mortgage rates from 2.8% to 6.9% over just 15 months, and a painful price drop, which is only just getting started, is inevitable. I 100% agree. And in Australia, if you guys in the US think you guys have got a housing bubble, you guys haven't seen Canada and Australia. And Danielle DiMartino Booth shared this chart. So this is housing demand in Austin, which is down almost 53%. Seriously unbelievable. So what I want to do now is just cut to a clip with Danielle DiMartino Booth talking about this housing problem.
Danielle, I personally continue to believe that the Fed is doing all of this jawboning because it's just not going to be able to hike rates as much as they keep threatening that they will for a number of reasons. But are they doing the market a disservice by doing this?
Well, look, Fed communication has never been the strong suit, Charles. I think we can agree on that after these last few years. That being said, every time that there is a rip-your-face-off bear market rally in which we're in the midst, as far as I'm concerned, the Fed has license to keep on tightening at this unusually fast and large in magnitude pace. And, you wake up one day and there goes a country or a country's currency. You wake up another day, there goes a company. And I think that they're just going to continue going until they feel that they've destroyed enough demand to bring inflation down closer to their target.
So, you mentioned about, you just sort of alluded to the idea of breaking something indiscriminately, by the way. To me, again, it seems nuts, and maybe they're already making mistakes. I saw your tweet where you pointed to the surge in principal year-over-year change in principal and interest payments. And this is mind-boggling stuff. This is the American dream up in smoke. You tweeted, though, this could be the vestiges of the mother of all Fed policy errors. So is this the first red flag for all of us?
Well, listen, Charles, housing is nearly 20% of the U.S. economy. It's not just a red flag. It's a large red flag. Americans have broader ownership of homes than they do of the stock market. We know how concentrated stock market ownership is. And think about a lot of the households who were getting in at these last few months, maybe with an FHA 3.5% down payment. And we're already starting to hear rumblings about home buyers with mortgages being upside down in their mortgages. Right. I never thought we would be talking about these things again, but this is something that the Fed created, Charles. They did not need to buy up a third of the mortgage-backed securities market, and in doing so, incite speculation.
So there's no doubting that we have seen the biggest asset bubble ever. The everything bubble. The everything bar gold and silver bubble. And, according to Keynesians, who've basically been the central planners for the last however many decades, believe in the wealth effect. If only we increase asset prices, people will feel wealthier. They'll borrow against those assets and go and consume, literally meaning to destroy. But now they're, inflation or CPI is a problem. They think, all right, we need to reduce asset prices so we can destroy some of those dollars and reduce inflation. They actually don't mind increasing unemployment as well. They really got this weird economic philosophy. It really is weird. And what I disagree with in terms of DiMartino Booth and others, that what the central banks are doing now is wrong. No, what they did wrong was back in 2020. In fact, I used to, back then I was talking to friends and family, and I said what was happening was wrong. All the central planning back then was wrong, and that there would be consequences happening, and they'd be like, "Oh, Steve, don't be so heartless. Don't be so wrong." I said, "No, that's fine, but the consequences are coming." And so the wealth destruction will continue. In fact, if we look at home plus stock value as a percentage of GDP, then to go back to a so-called normal, which is 200% of GDP, we're looking at a 40% crash remaining from these levels. Now, this chart's been doing the rounds on FinTwit in the last couple of days, 4 centuries of boom and bust. Whenever house prices did boom above rents, they would always come back down. However, right now, look at the disparity between house prices and rents. Now, I've shared this chart before. Australian bank lending and value of land. It's all about bank credit. All about bank credit. And, well, let's have a look at where bank credit is going now. So I follow this very closely because this is what the Austrian business cycle theory, this is what the Mises calls the crack-up boom. And so we saw that these new loan commitments were going vertical, not sustainable. Not sustainable. And so we knew that house prices would ultimately rise, and that's what's happened. Guess what? That trend is now in reverse, and guess what's happening with house prices? It's pretty basic Austrian economic stuff, folks. And if we have a look at Sydney or New South Wales, Australia's largest populated state, that's leading the way. And here you can see from CoreLogic that Sydney is down 10%. It's now double digits. And look at Brisbane in the light grey there, down 6.2. In fact, Brisbane is falling the fastest at the moment. Yet we've got the Olympics coming up, and that's supposed to be a boom for Brisbane property prices. You know, it's supposed to be booming. What's going on? If we actually take the 3-month annualized rate, Brisbane is falling at 19.6%. Sydney, 19.9%. However, Brisbane, just in the last couple of months, has really picked up pace and is now outpacing Sydney. Now, this is a very interesting chart, share of loans of negative equity. If we have a look at new loans that were originated in 2021 and 2022, we can see that with first home buyers, almost 50% of them are now negative equity. And this is a big problem. And there's going to be a term that's going to become well known called mortgage prisoners. So when people have negative equity, they can't refinance. People can't service. So, you know, when rates were at 1.89, their borrowing capacity was very high. And a lot of first home buyers borrowed towards the maximum of their borrowing capacity. Now that rates have gone up, they can't even afford the mortgage that they've got, meaning they cannot refinance. They're a mortgage prisoner. And here in Australia, if they sell, well, you know, they got negative equity. They'll have no house plus the debt on that house to pay off. And our former boss on his way out of APRA, our prudential regulator here in Australia, said significant repayment shock for fixed rate borrowers. And what he's talking about is those that took out fixed rates at 1.89%. And there was a big portion of people that did take out fixed rates, especially 3-year fixed rates at 1.89%. Well, according to the market, they're going to be rolling off and paying, 6.5%, 7%. So 1.89 up to 6.5%, 7%. And a lot of those are first home buyers. So here you can see the sharp decline, the rate of Sydney house prices in green 2022. It's really falling faster than any other time in Australian recorded history. And the 5 cities put together, peak to trough, once again in the black 2022, it's falling at the fastest pace in recorded history. And here's a big problem. So Australian debt repayments to household income, well, you can see from the GFC right through, we've had basically falling interest rates. However, now we've got rising interest rates. So you can see the Economist's forecast of 2.75%. You can throw that out the window. That ain't happening. That's silly. Market forecast 3.7%. So this is a little bit old, this chart. So the market is actually predicting over 4%. So you can see this is going to be a big problem for Australian households. And in fact, here is the cash rate futures implied yield curve. And you can see by June 23, so that's June next year, it's only months away, the RBA official cash rate will be over 4% and will peak at 4.255% in November next year, but it will still remain at 4.2% even out to March 24. So if that's the case, then we're looking at mortgage rates of between 6.5% and over 7%. Now, a lot of those people coming off 1.89 to 6.5%, 7%. And that's not even taking into account the CPI increases that is eating. We're already seeing CPI is eating into people's cash flows right now. We are seeing it in a big, big way. And it's only going to get worse because not only do Australians have high mortgage debt, they've got high household debt. So car loan debt, credit card debt, personal loan debt. We have enjoyed consuming over the last 2 decades. And even, Australia, we have a very high top personal income tax rate. And the problem is it kicks in at a much lower threshold than most other countries around the world. Yes, New Zealand's lower, but their top personal income tax rate is also lower. So there's going to be a big, big cash flow issue happening very, very soon. In fact, it's already happening. Now, I do apologize. I do not remember where I got this from. I was reading this and I took a screenshot. So whoever did do this up, I do apologize. I wish I could give you credit. Given short fixed rate periods, 35 to 40% of UK mortgages may see higher rates in the next 12 months. Resets are significant for both banks and borrowers. 6% new rates versus 2% rates in the back book. With high utility bills, a 6% mortgage rate could mean that 30 to 40% of UK households struggle to pay their mortgage. And mate, that's the same. Australia, New Zealand, Canada, US, you name it. This is the same problem everywhere. Now, yes, the US have 30-year fixed rate mortgages. However, it's only the marginal buyer that can make the big difference in terms of house prices. Go back, have a look at the delinquency rates during the GFC. The way the media spins it, you'd think that 90% of all mortgage holders back then defaulted. No, it was not that at all. From memory, it was around 11%. It peaked out. So there's a lot of people in the US with no mortgages that will be selling. What about new buyers coming in? So just because you've got a 30-year fixed rate mortgage doesn't mean that it these higher rates aren't going to affect the US property market. And if you guys think the US property market's in a bubble, like seriously, check out Australia and Canada. And foreigners to liquidate another 400 million of Aussie mortgage bonds. So when the gilt problem was happening, pension funds were liquidating everything they had to meet margin calls, and that meant Australian mortgage-backed securities. And when this liquidity event really does happen, there's going to be a big, big problem for Australia, for our currency, for debtors. Like this is going to become a big, big problem. And nobody is talking about this in Australia except for John Adams and myself. In fact, I did this video, Australia's Coming Economic Collapse, where we talked about Australia's debt problem, Australia's balance of payments crisis, that is a real risk. It's a real risk of happening. Superannuation funds, retirement funds all around the globe are highly leveraged. I mean, this is just this is going to explode. This is insane. All right, and back to the US. So here we got home builder confidence and home buyer confidence. Home buyer confidence now all-time record lows. And home buyer demand is collapsing. So we all knew, during the lockdowns, but then governments came in and just threw the kitchen sink at it. People didn't have to sell their homes. There was mortgage moratoriums. There was governments throwing 0% rates. Central banks, banks were getting rates dirt cheap, being able to lend. We saw housing go up. We saw some governments allow people to take funds out of their retirement accounts to use as deposits on a home and so forth. So now we're not seeing that. Why? We got a CPI problem. We got a debt problem. So as I keep saying, it's assets or the currency. Take your poison, so to speak. And when we overlay homes under construction, well, we're probably going to have a supply-demand problem here. So if demand is falling off a cliff and we still got homes under construction, are we going to get a supply-demand problem here? And even The Economist just did a tweet the other day. where they've now joined the club. So over the past decade, owning a house has meant easy money. But today, if your wealth is tied up in bricks and mortar, it is time to get nervous. Rising interest rates will have unpredictable political repercussions as people who once benefited from the status quo discover what it feels like to lose out. And for years, more established homeowners took comfort in the thought that even if real wage growth was terrible, at least the price of their house was rising. Those days are over. And house prices now falling in 9 rich economies as inflation and recession stalk the world. A deepening correction is likely. And here's a chart from The Economist which shows the housing risk indicator. So the countries that are most at risk. Canada takes number 1, Netherlands number 2. There's a 3-way tie for third between Australia, New Zealand and Norway. And here from the West Australian, The Economist stretched Australian households to lead global property bust after pandemic spending splurge. Well, and that is where the problem started back then. And here's several US cities. Have a look at the decline from peak. These are declining quite fast. This is happening all around the world. And once again, here's a problem. So home buyer mortgage repayments up 50%. 50% from 2020 and 2021. Once again, I know a lot of people locked in at 30-year fixed rate mortgages. Good on you. This is still going to be a big problem. And I thought this really sums it up for me. You want me to pay 2021 prices at 7% interest. That's really a joke, but it's serious. You want me to pay 2021 prices at 7% interest. That ain't happening. So it's basic math, basic economics. Anyone that has any basic understanding of Austrian economics saw this coming. The business cycle theory, the crack up boom, as Mises said, the bigger the boom, the bigger the bust. And well, I believe it's only the beginning, and there's a lot more pain to be had. So where does one invest? Does one invest in the stock market? Well, I'm going to do a video on something Stan Druckenmiller has recently come out and said, and something that I've been saying for some time now, that index investing is very dangerous right here, and the stock market returns over the next decade are probably going to be flat at best in nominal terms, and probably decline quite a lot in real terms, because I still see an inflationary decade ahead, even though asset prices are likely to be much, much lower. So stay tuned for that. And, basically our insiders, you guys know my portfolio. I'm holding the most amount of cash ever. I'm holding the most amount of physical gold and silver ever. I have selected stocks that are in particular industries that I think will benefit over the coming decade. Now is not the time, in my opinion, to be index investing. I think people are going to get hurt, even in nominal terms, but definitely in real terms. So be very, very careful. Anyway, what do you guys think? Do you think the the housing market crash has just begun? Or do you think the Fed pivot's going to save the day? You'll see in my next video what happens after a Fed pivot. You'll be quite surprised at the data that I'm going to share in that video. But do you think that governments will come in and save the property market, the housing market? Love to see your thoughts and opinions in the comments below. Once again, if you like this video, guys, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor, having regard to your own objectives, financial situation, and needs.